Okay, so Techboard, I'm not going to give the full story on what we do, but we've been producing funding reports tracking, which is from the funding that we've been tracking since the first one we produced was the December quarter 2016, just for WA. We started collecting data nationally 2017, and we're about to produce our second annual funding reports for the financial year just gone. Why do we do this? Well, it's basically for the future of our kids. Startup and tech companies are where the future wealth's going to come from. So that's why I'm doing this. And we've had our reports covered in a wide range of press, which is all up there. And now for a very quick snapshot of some of our data. All our funding reports are freely available if you sign up. You can subscribe to have access to the underlying data. We've got 3 different packages. If you want information about subscribing to our data, just let me know. So, I've just got here a number of charts that I've put together, which are just showing size of deals, number of deals in each band. And this is a trend that we identified for our last report, that there seems to be a decline in the number of deals. This is what we've picked up on. This is not saying this is the investments that have been made. The way we collect, we pick up on data from the press, what's reported to us, and we use a combination of manual research and scraping and crawling. So this is private deals, and you'll see the top segment is generally getting bigger and the other segments are not. And public funding, so this is startup and tech companies on the ASX, companies up to 10 years old. That's been sort of a bit over the place, but a very strong quarter just gone. And for example, the biggest transactions there, you would have all heard about the Prosper IPO, which was, they raised 110 mil, and Afterpay did a massive placement of over 300. So that's, part of that. And so this is placements to IPOs or reverse takeovers, and that number is, that top segment is the IPO or RTO, and that's been, it's variable but quite small at the moment. And this is just looking at funding by type and value. The private one is, I'll just point out this one, ziggy-zaggy up, and public is this big one going here, the other one's debt. They're the 3 main sources of funding that we identified in our last funding report, with roughly $1 billion each over the previous financial year. So there's the big spike there. The Afterpay was a large component of the big spike in June. But this slide is the difference quarter last year to quarter this year, which it's recovered slightly, but basically that's tracking the curve of the private deals, which seems to be, it's still increasing, but the rate of increase is slowed. And that's total amount of funding rather than individual deal size. So that's just a snapshot of the sort of stuff that we can do with the data that we're collecting. But a major source of data for us is what's reported to us. So deals can be announced on Techboard. It's an announcements platform as well as just reporting deals to us. And we're really encouraging people to report deals to us so that our data improves for the benefit of the ecosystem. We're also looking to make our data available to investors, investment funds, and that data helps them make their investment decisions. And so, you've heard enough from me. Let's let the roundtable begin. Okay, so yeah, this is a slightly different format than many of you might have seen before. It's like a panel session, but the conversation stays mostly around the table until we break for questions towards the end. So it's a slightly different dynamic, but we've trialled it a couple of times back over in the West, and very glad to have brought it over here. And thanks, Jess, for helping make that possible.
No problem. Exciting. Are we going to start with going around the table for introductions?
Yeah, I think that's a great way to start.
So if everyone wants to take maybe with you at the mic first there, we can have introductions of everyone around the table. It would be great to hear about what you do and share with everyone else.
My name's Alan Jones. Yay, I'm not the Alan Jones that you thought of. I'm the opposite of that, Alan Jones, which is nice. I have several M8 Ventures logos on my shirt, but I work with accelerator programs as an entrepreneur in residence and try and identify early stage talent in those teams. My venture partner Emily and I are currently raising our first fund together to focus on pre-seed and seed stage tech startups.
Lynda Coker, and I guess firstly thank you for pulling all of us together, because I think we all wear slightly different funding and ecosystem hats, and I think it's an important conversation. So I do a couple of things. I guess I'm sort of here with my Scale Investors hat on. So we're an angel syndicate investing really at the seed stage for female entrepreneurs across sector. I'm also involved in running a tech incubator at the Sydney Startup Hub, but I work a lot with fintechs. I'm actually sort of full-time at Vault Bank at the moment, helping them launch their platform. So I get to see a few things, but I really do think, you know, it's a very important conversation to have, because I think that seed to A journey is really quite difficult here. So I'm looking forward to talking about it.
Hello everyone, my name is Peter Ellis, and I'm the CEO of the ACS Labs, which is, so you might know, River City Labs, which has been going for 7 years in Brisbane. We were acquired by the ACS last year, which means we've now launched Harbour City Labs here in Sydney, down at Barangaroo, and we have Bay City Labs in Melbourne in Collins Street down at Docklands in the ANZ building. So I've been involved in the ecosystem for the last 7 years, driving the Queensland startup ecosystem. I work very closely with founders. People are my thing, numbers aren't, so it's fascinating being on this table. We run a lot of different programs for startups. I've also co-founded a program called Peak Persona and 3AM Tribe, which focuses on founder wellness, which plays a huge role in the success of the founder journey and actually raising capital, because usually when the pressure gets too much, the founders crumble. So programs like that are a passion project of mine.
Thanks, Pete. My name's Rajeev from Allium Capital. We're a fund that's about 4 years old. We manage just under $250 million. We're not a venture firm, so we're a crossover firm whereby we do listed and unlisted. We've got 43 investments today, the ones that you may have heard of. Koala, Daisy, Billiana from Daisy's here. We have Nitro, Face Me. Our goal, medium to longer term, is to try and bring more mature companies to list on the ASX. We will support Australian founders globally, so our companies today are in Australia, Singapore, Hong Kong, New Zealand, and the US, and they're all Australian founders.
Hi, I'm Jonny Wilkinson, and not the Jonny Wilkinson. Fortunately, my namesake has more positive connotations. I'm one of the co-founders and run Equitise, which is an investment platform. We primarily do equity crowdfunding, so we're helping private companies raise capital all the way through to IPO.
Hi, I'm Andrea Gardiner. I'm the founder and CEO of Jelix Ventures. I founded Jelix Ventures a few years ago now to provide access to highly selected technology startup opportunities to more investors. There's a gap in that kind of seed funding area, you know, kind of between sort of friends and family and bootstrapping and Series A that the VCs were doing well on. And the seed area is kind of, there's a lot of sort of fragmented angel groups and informal angel groups, but there's not much in the way of professional investing. So that's the gap that we work in. So we've done 15 investments so far. All our investors got 10x on their one of the earlier ones last year, so we were pretty pleased about that. And after having to push quite a big round on probably one of the hottest deals of the year last year, which wasn't ever reported because the founder didn't want it reported. We sort of pushed that Airtree's way because we didn't have a big enough pocket to do it. So we're about to raise our own fund, so we don't have to have to push our deals on to others now.
I'm Raf Kimberley-Bowen, also from part of the WA delegation. I'm an entrepreneur and investor, so I helped set Techboard up with Peta. I'm on the board of Perth Angels and a venture partner with 808 Ventures, a small VC fund based in Perth, and on the board of Startup WA, which is our peak body for startups. And also I set up, and I'm a director of Scale Partners, not to be confused with Scale Investors. It's a boutique professional services for startups.
Dave Weir, I'm the CEO of Radium Capital. We provide funding for those companies who receive the R&D tax incentive. We help more efficient use of capital is the way I really put it. We effectively turn the annual R&D tax payment into a quarterly payment. So you're right in terms of there's some great different areas of funding around the table. And I guess I wear two hats in this as well. Radium Capital was a startup, less than 3 years ago. I guess over that journey we've now provided capital to well over 250 businesses, and I think we're just shy, providing 90 plus million to across those companies. So we're a big provider of capital here in Australia.
Thanks everybody. Just to introduce myself as well, as per Peter's introduction. My name's Jess Olivier. I'm a partner at RSM. We're a mid-tier accounting firm with a presence across Australia. Actually, Perth WA was our first base 96 years ago, when have lots of regional offices in towns and cities I'd never even heard of when I joined RSM 4 years ago.
We don't have many cities over there.
No, sorry, but across the country, yeah, we've got lots of regional offices. Now I lead the East Coast R&D practice, so work very closely with David in terms of funding some of the startups I get involved in, which has been really rewarding for them to be able to access that funding earlier in the piece in terms of the R&D tax incentive life cycle. Pleased to be invited today to help facilitate with Peter. I guess in terms of getting started, and as you said, Peter, these reports are released quarterly, and if you look back on them, they've showed various levels of growth in funding and different types of funding across a number of sectors. I know previous discussions focused on, obviously, on WA and the funding over there, which has been a different kind of scale to New South Wales and Victoria. I suppose for me, looking through the last few reports, one of the questions I suppose I'd like to raise first is about whether you think the reports have shown a apparent slowing in funding on a smaller level. There's still some big funding up the top there, but I guess I'm just interested to hear from the panel and whether they think that is actually the case, that funding for companies is slowing down, or whether it's just that perception from the market and how it's reported, I guess. I think that's good. Thank you.
Yeah.
Thanks. I think that's really interesting. I do think it's hard to get real transparency, I think, on the level of funding with those early rounds, just because there's no real standard reporting. We don't have a crunch base. Maybe this is going to fill that
we
gap.
are crunch base for Australia, but with better data.
Yay! So that's
but a worse platform. But yeah, we're working on that.
But I think that's going to be really helpful and really important to inform the whole ecosystem in a much more informed way. So I think there's a reporting issue. As I mentioned earlier, we've done quite a few rounds now where the founders actually wanted to keep in stealth mode, even at Series A. And I do think that there is I actually accept that there probably are more deals and bigger deals happening. But if you look at the VCs, there's more money being invested. The funds are getting bigger. The fund economics of actually writing small checks are just not there. So the bigger VCs need to be doing later round deals with a bigger check. And a lot of those I think there's a higher kind of reporting rate of those sort of deals. So I think they're more visible. And I think in your sort of briefing notes you mentioned something about maybe people with the smaller rounds don't let the press know or don't report it in other places because they think it's not newsworthy, I suspect, and I have no idea how much that contributes. But I do think there's the professional investing is really moving further along the sort of the the life cycle of the funding, sort of Series A and on, and there's very little of the big VCs investing at that angel stage.
Sorry,
Yeah.
can I ask?
what I think.
Does anybody know of a seed stage
Is
startup?
it switched on, sorry?
Hello? Can anybody hear me anyway? Can
just
anybody name
if you could.
thank you, a seed stage deal in the last 2 years in Australia that was oversubscribed? So I think that's
Oh, I've had a few.
several. Cool.
I've had quite a few.
Cool. So I think
in fact, I had one closing one tomorrow.
Cool.
That was way oversubscribed.
Way oversubscribed. Cool. I think that's rare, and I think that's one of the reasons why people raising early stage capital tend not to be super keen about announcing the fact that they've raised, because often I think they've started here and then they've ended up settling for here, and it doesn't feel like something they want to trumpet.
Sorry, can you use the microphone?
I think that's right, and I think the fact that you don't have so much professional investing at that seed stage, and a lot of people are angel investors, they're investing often, emotions are coming into it a lot, and I think our valuations aren't inflated to the extent of Silicon Valley, but some of the founders that come to me with pre-revenue, maybe post-MVP, sometimes pre-MVP, and they want multi-million-dollar valuations because they think that's what you can get, and there's no value there at all, even approaching that. So I think that sort of emotion-led investing is inflating valuations a bit, and this is my personal thoughts here and my impressions, and I think the valuations are getting up and up and up, and that I think it puts people off because you're not pricing in the risk for investing so early.
I think also and following on from what you were saying in terms of the needing to come down in what they aimed to raise and what they actually do end up raising, but also for the startup, the perception that comes with having raised and the pressure. A lot of them want to downplay, obviously, what comes next. So if they have aimed to, go for 3 and they're getting 1.5, they want to keep that on the down low. So when they do go and ask for more, it wasn't, it's not as obvious that they, only went to market 6 months ago. So we always encourage, them to ask for more, to project for further, so you don't have to keep going back and asking for capital. But we see the trend in startups not wanting to look like a startup anymore. They want to look like a professional organisation, obviously for their acquisition of customers. So often they play it down because they don't need the funding, but they're actually this professional organisation with customers who are paying them money so that they can actually get those bigger deals. So there is a benefit to not announcing those earlier raises, to not position themselves as a certain type of company.
Right.
It's the same sort of thing with working within startup hubs. Sydney is a very professional workspace at Harbour City Labs. All the teams in there are post-revenue. They're all scale-ups, B2B enterprise. They choose that location simply because they don't want to be a startup. They don't want to work out of a startup hub. They don't want to look like a startup because they want to appear like a professional organisation. And it's similar theme to how they are perceived at raising those earlier rounds.
I think part of it's also cultural.
Can you just pass the mic?
I was saying part of it's also cultural. I've spent a lot of time in New Zealand and they're the same over there. It's an Anglo carryover of, it's rude to talk about money, right? There is still an element of that in that some people don't necessarily always feel, despite wanting to be an entrepreneur and celebrate what they're doing, that it's appropriate to go out and say, we've raised X dollars and this is what we're doing, and those sorts of things. And getting to the point where people go out and look to raise a targeted amount of money and might not hit their maximum, so that in some sense they feel as though they're not hitting their targets or out achieving, so they don't go out and talk about it as well.
Right.
We get a lot of that where we sit down and spend a lot of time working with companies to work out what they need and what's an appropriate sort of runway and set that as their minimum funding target. And then we'll say, okay, well, what's appropriate and what do you feel comfortable in raising? And if the money's on the table, let's have your minimum at 500 and your maximum at 1.5 million. And if it's there, we'll take it. So that element of you haven't hit your perceived maximum funding target is also something that people get caught up onto.
Mm.
Can I make some positive and negative statements?
Go right ahead.
Look, I think in Australia we have really, really good ideas. We do. We have really, really great university research too, but I think it's that commercialization of that research which is often an issue. We've got lots of great startups across different sectors, but that first sort of funding round is quite hard, and I think it's structural as well as cultural actually. So if you think about where do you go for seed investment, right? That is typically, as Andrea said, so friends and family, and then you kind of move to angels, family offices, sort of VC. And my thoughts are that if you think of Australia as a market versus other markets, and you think about angels in other markets, are typically serial entrepreneurs, prolific, that channel money back in. We don't have so many of those. And I think it's not that there isn't money, there's money. I think there's a lot of high net worth individuals out there, but their money is in property, super, and listed investments because of negative gearing, tax concessions, and dividend imputation, right? And it's not that there isn't incentives there for early stage investment. There are tax incentives there. They're not necessarily as good as in other markets, but I just think there's a connectedness issue. I'm not sure they're necessarily connected to the ecosystem, and I think there's some education and sophistication in terms of angel investing as well. I think VCs, to Andrea's point, they've raised a lot of money. It's not so much that they haven't raised a lot of money, they just typically do invest later stage. They're not, I think, venturing, which to my mind is seed investing.
Well, from what we've picked up with just looking at the big ones, Airtree, Blackbird, Airtree's investing in rounds that are down around the $1 million mark. They're not just doing later stage.
No, and there are some VCs that do invest in seed. Don't get me wrong. That wasn't sort of a blanket generalisation that it doesn't happen. But I think there are a lot of VCs out there that don't, but they call themselves VCs. And I think there was, I'm not sure whether it was Techboard or somewhere else, but I saw data around sort of the dollars raised and sort of, I think there's two issues. Time it gets deployed. I'm not sure it necessarily gets deployed timely, and also it is later, tends to be later stage versus early stage. And in fact, there were stats in the Crossroads report from last year that Startup Oz released that that it looked at seed investment per capita. Now Australia was like $3.20. We sort of trailed New Zealand, which was $5 something. The US was $25. Israel was $22, and the UK was $12. And that's on a per capita basis. But we are sort of maturing. But like I said, I think it's sort of, you've got to look at the different sort of parts of the chain and who those investors are. And I think equally institutions tend to be quite risk averse, and you look at corporate sponsored accelerators and others, it tends to always still be later stage. And you look to the Valley and other markets where you actually get, corp devs within institutions looking to co-invest with VC, in early stage businesses that are going to disrupt their business. So I think there just needs to be, again, a bit more engagement. Like there's money here, there really is, but I think that engagement and deployment of funds.
So I think it's more than
Microphone.
just engagement.
Sorry.
I agree with you. Well, firstly, I think in terms of the funds, the percentage of capital deployed on seed stage is usually minuscule. So it really doesn't have a massive impact, I don't think, in terms of meeting that funding gap at that seed stage. But to sort of follow on from what you were saying, Lynda, the reason that I started Jelix Ventures was because, I'd go along to different pitch events, but in particular Innovation Bay pitch events, and we would see what we thought were great opportunities come and go and not be funded. And we were actually really concerned and wondered why there was so little actual investment going from the investors in the room into the startups. It was quite disappointing. And we kind of theorised, we hypothesised that maybe it was it's a high-risk asset, high reward, but very high-risk asset. And there really wasn't a depth of expertise in the ecosystem at that time to actually know how to look at an investment like that. I've met lots of family offices that have been burned investing in startups because they've approached it in a similar way to investing in a SME, and then they've had their fingers very badly burnt, or their pockets, I suppose. So I actually think there is a funding gap there, and I think that gap could possibly be increasing because of that migration away from seed and up to the less risky area of A's and B's with the professional investors. And at the same time, I think it's getting better because we do now have repeat entrepreneurs coming along. But I do believe it's because there's just our startup ecosystem is maturing, but we're not there yet where we've got a depth of repeat entrepreneurs that are really active angel investors. We've got some, and it's growing all the time, and it's awesome, but we just don't have a huge depth of that yet, and that's what we need, and that's just time.
Well, Blackbird Ventures' first fund, I think, is going into its 7th year now, and its first fund was 28 million, and now has approaching 29.5. And how much do they have in total under management now? Like approaching $500 million? 400 million? Yeah, so that's a tremendous growth in capital under management. Right. And so you can be doing, you can be leading $1 million rounds 20 times a year, and still 90% of your capital is going into later stage investments, And so Airtree, Blackbird, they will still occasionally write a pre-seed or a seed check, but it's for the exceptions. It's for those truly remarkable, and it's much, much more likely to be lab-grown meat than a two-sided online marketplace. Like their seed purpose now is now really, really ambitious rocket science stuff, and the rest of us trying to build, we thought we were meant to build like resilient, robust, revenue-first kind of startups, and that was what investors wanted. Blackbird and Airtree don't want to see that from us anymore. Now they want rocket science. And so now, I work with accelerators a lot, and companies graduate from accelerators thinking you go to demo day and you pitch and then you raise seed. And the whole reason why we have things like convertible notes and safe notes is so that angel investors can rush forward at the socializing time and get in on the deal before the other angel investors beat them to it. We don't have that mechanism, that same balance of capital and ideas in Australia. Instead, it's taking our accelerator companies 12 to 18 months to raise that first seed round, and a lot of them are good companies that just can't make the runway last that long.
And I think that's really sad.
Just wanted to add, I think, a couple of points there. One was yours around having, I guess, the successful entrepreneurs with exits investing, and there was a point earlier on about education, and I think it's at that earlier stage, angel groups play an important part, an important role in the ecosystem in terms of providing that sort of, I guess, education on how to invest in early stage, how to invest in tech. And I'm thinking from a WA perspective, but I think this works across the states. In WA, we've got investors who they know mining. They invest in early stage exploration stocks, and that's what they know. And so there's a role to be played in terms of educating how to invest, and it's imperfect, but there's something that's happening there. What we don't have is we don't have enough successful tech entrepreneurs who've had an exit who are investing. So when people come to pitch the Perth Angels, theoretically what's happening is it's smart money. It's not just a passive investment. You're getting access to investors who can add value, and that happens to an extent, but nowhere near as much as it should, because you've got tech entrepreneurs pitching to people who've never run a tech company, and there's only so much value they can add. And I think that's one of the big gaps that we have at that earlier stage.
So a few comments based on what's been said. So in the last 3 years, we've seen probably 1,500 investment opportunities, and we've made 43 investments. One of our investors is a top 10 Australian family office, and prior to investing in our fund, and they invested in other funds as well, they had made 61 seed private investments, of which 54 had failed in the first 2 years. And the average that they'd invested was $100,000. So they give a little bit, but they're prepared to lose it. But they're worth billions of dollars, and they don't care. And our pitch to them is, you can lose that. You will have a little bit of tail. Why don't you formalize it? It's hard for you to say no to the financial controller's daughter who wants to build a business, but it's not so hard for us to say it if it's not a good investment. So I think formalizing the investment approach is quite important, which is why maybe there's been less, to Alan's point out, maybe there's just not enough seed money. Maybe there's a different way of finding that seed money. The other comment I'd make is 2 years ago, we backed 21 companies that year. The average age of the founder was 28. Last year, the average had increased to 36. And the reason for that was we were green to what we were doing and we were just investing anything we wanted. Last year we wanted to focus much more on returns and better businesses, so we started to do that. And what we found with the 36-year-old, on average, the eldest was 61, is that they have actually put a lot more capital to work themselves. So in the prior year, a lot of these people were turning up and saying, hey, can we raise X $1 million? And they would draw a salary of $175,000 to $200,000, and they put zero in. You know, they talk about, you know, their time. Time's valuable. Everyone's time is valuable. But if you have no money in, it's just not, it's not compelling enough.
Yeah, I think I'll just make a few comments based on, like yourself, what's been said. My personal opinion is that what's happening in the market now, it's busier than ever. My business, you know, we've tripled the size of the business over the last two years. So, you know, it tells me that there's more deals to go. Currently, we've got over 100 positions, and I would say that every one of those companies is either just completed a raise, currently undertaking one, or looking towards doing one. And with the data, and I think that the key there is reporting, but I think there's also a lot of other options out there, and I think it goes to your point of education. A lot of my customers actually call me and say, oh, you know, that was great, Dave, appreciate the help with R&D stuff, but obviously I can't fund your business from go to woe. They want to know where to go next, and to be honest, a lot of the time I'm at a loss where to put them. So I think, you know, to your education piece, you know, I think that's a really big part of the market. And then if you can tell these people where to go, you should be able to close that loop in terms of the reporting. But yeah, I mean, we're sort of seeing a big push into a lot of startup firms, a lot of guys that are out there raising, not necessarily knowing what they're doing. And if they're not knowing what they're doing, they're not knowing the conversation they need to have or where they need to go. But then, you know, with a lot of these companies, they are very good. So people do pick them up and do fund them, but it is done on a side deal, or if it's done somewhere else, until they get to a point where somebody can actually take that business and really run with it. So I think my points are that, you know, the market, there's more going on than ever, especially in the last sort of 2 years, but also, you know, really that there's a whole lot of options out there for what's available to these companies, and really making a head and a tail of those options is really what's sort of key.
I agree, and one thing I want to go back to is it's not so much a gap in the market. I think there's a gap in education for investors, and bringing people in from those traditional investment portfolios and educating them on the opportunities within the tech sector. And there's various ways, obviously, but we need to be more actively approaching them and showing them and drawing them in, like actively recruiting the people with the dollars into this sector and showing them. But we do that through storytelling, obviously. So seeing the success of previous investments, allowing them in to share, you know, be a bit more open book on how those deals are done. We run a program called Startup Catalyst, and we take an investor mission to Silicon Valley with investors from Australia to Silicon Valley to meet investors over there, to understand how they structure deals, but also to you know, get them excited about different ways of, you know, different levels of opportunity if they were to actively deploy money into Australian companies. So that's just one way, but then we run the River Pitch program, which brings investors together with companies who are looking to raise, just like Innovation Bay. So actively doing those things to bring the two worlds together, we have to put more effort in to upskilling some investors to deploy the capital into the companies. So there's just a lot more knowledge sharing that we need to do. We need to be more open about that so that we can share the skills of the entrepreneurs coming out of the companies. The other piece is going back to the age. The startup average age of startup founders is 38, I think, across Australia at the moment. But what I'm seeing now in companies who I've been watching for the last 7 years, or they've exited or been acquired, so those founders are now going back into younger companies. They're saying, instead of going back and investing, they're now wanting to go in at a CEO level or the growth level, because they know that they want to go in at a company that has already done all the hard yards. They can go in and grow it to the next level. So I think it's just time. We're going to see those founders come through, or those entrepreneurs cycle through with their experience, have impact on 2 or 3 companies before they cycle back out and then become investors and actually take a less active role within those companies and then just deploy the capital in. So I think it's just time. We're you know, this is like a 20-year journey. We're halfway. We just need to wait a little bit longer and keep doing a lot of this activity.
So just picking up on a couple of things there. We've seen some changes in the coverage of startup over the last year. Startup dailies sort of went offline for a bit when they lost their journalist and took a while to get back on board. Business Insider, when it was acquired, sort of stopped doing anything startup. The amount of resource initially in AFR seemed to drop as well. I think that's picking up again now. And on the Australian doesn't seem to be covering much in the space. So is anyone here seeing that startups are trying to get coverage and failing because of those sort of structural changes we've seen?
We haven't had any trouble, actually. So, look, I'm just thinking of the ones over the last sort of year or so. We've had really good coverage in the AFR, and then other publications have picked up from that. And the founders that we've invested in haven't had any problem either. So I haven't seen that.
I think it's just again, it's that storytelling piece. So what's actually interesting? So I've been involved in PR and media for quite a while, and it's, you know, startups don't really know what that story angle is going to be, and a lot of the publications will just report on things that are relevant at the time in the media. The media is a difficult thing to align with for startups and to find that unique story angle, and you have to really dig deep. But it's usually to some sort of personal story. It's some sort of creative, you know, innovation, something that's going to shift the dial globally, but also has to appeal to. So it might be interesting for all of us, but for the mainstream media, which gets the ratings and the readership, it doesn't appeal to them. So we need to, there's two different markets that you're talking to. So there's everyone like us who are interested in all the details, then the general public, who the media are driven by those stats of readership, and you have to find the two different angles of who's going to appeal to what market.
Yeah, I actually think it's the dead opposite. Radium Capital itself, we had massive traction in the media when we did a sell down event. And what we found was that the media was actually hungry for the story, because, you know, there is a big community of startup businesses. Everyone sort of knows about it. So when there is a story, it actually got picked up and covered quite well. You know, Radium was published in the Australian, the Fin, the West Australia. It was in a lot of papers, and that was just because they're very hungry for a, like you're saying, a startup story to tell not only our community, who is, you're right, very invested and wants the details, but also, you know, there's a lot of corporates out there that know this scene exists but don't really, you know how or where to look for the info. So I think it's kind of the dead opposite. People want the news.
I think if you're able to blog about it yourself, Startup Soda and Techboard will perhaps cover whatever it is that you've done. If you've done a 1 million raise, Startup Daily, when they've got editorial staff, will cover it.
Which they do now.
Right, but it needs to be more than just we're announcing we've closed a 1 million raise to get into most of the other publications. To go from there, you need to be more creative, and I think, you know, unless it's a 50 mil raise, AFR is probably not going to cover it, and the Australian will very much depend from week to week what David Swan's got to write about, you know, what else is on his mind. But so for instance, I'm working with a founder at the moment on an opinion piece for hopefully the AFR about crowdfunding. So he's about to complete a successful crowdfunding campaign, and I said, well, you know, it's great that it's been successful, but that doesn't really matter to a mainstream Australian business audience. But what if we wrote something on, if you're ever considering a crowdfunding campaign, here are some tips that I learned through, you know, the hard way, share with you. That opinion piece might get a run in one of the papers that way. So yeah, trying to, you know, the rest of Australia isn't interested anymore in us successfully closing funding rounds unless it's 100 mil. It's got to have something to relevance to business or to customers or to readers.
Yeah.
And maybe just sort of trying to bring those two strands together of, you know, educating investors on the asset class and that piece around press coverage and promotion. And it's a bit of a plug, but we organise the Australian Angel Awards, which...
Thanks, I forgot to mention that earlier.
yeah, which plays an important part, and the reason we do that is that it's about raising awareness of the asset class. One of the categories there is exit of the year, and what better thing to celebrate and promote than investors who've had a successful exit. That's the best way of attracting investors.
So last year that was J-Ride.
That's right.
So that was led from Sydney Angels, wasn't it?
It was a Sydney Angels investment with a subsequent equity crowdfunding round as well. So again, that's a good story because it's, and maybe it's something we'll get to later on this panel, but it's about combining asset classes, if you like, or combining types of investment. Sydney Angels have done that quite well. They've done Fame & Partners with Venture Crowd. They did this one. Perth Angels have back to business that's about to go live on Equitise as well. And I think that's an interesting space as well around that kind of crossover between different investment types.
That also got the Dragon... Sorry, I want to say Dragon's Den.
Shark Tank.
Shark Tank, yeah. Lived in the UK for a while.
Just a really brief comment, and I think it's also about combining forces, and I think we're getting a little bit better at that. I think, as angel groups, we should co-invest together and co-invest with VC more and sort of share deal flow, etc. Because let's face it, Australia is 25 million people. We're not that big, right? And okay, fine, Perth, you might know a bit more about mining there, but there might be others that are interested in investing in that. So I think it's more, and I think founders sort of often go and do the rounds, and that's not efficient for them. So I think I'd love to see more of that. So more of sharing deal flow, more kind of co-investing together. I know certainly there are rounds that we can't fill ourselves. We've co-invested with Airtree on things and others. So I'd just love to see more sharing and pooling funds together.
And I think that comes back to David's point about knowing where to go next after you've dealt with your clients in terms of the debt funding as well.
Yeah, absolutely. I mean, we do, like I said, majority of my clients are looking for capital elsewhere. So I think it's really a part of, you've really got to look at your capital structure and make sure you've got a good mix of what's gone in there, from debt to equity to specialised products, whatever they're going to be. But making sure you're not pinning all your hopes on some magical VC guy that falls out the sky and writes you a big cheque, because might happen. So I think, you're right. Thinking about the funding mix in startups is something that is becoming really common. I get a lot, and I work alongside a lot of institutional investors, VC firms as well. We do a specialist type of finance, which works well for the customers. But we stick to our patch, and that's what we do, and it allows them to then go out and raise other forms of capital, whatever they are. So I think that mix is a really important component.
We have too many egos in Australia to make that work. We can work on it though, definitely, because that's the issue, is we don't look at the Australian opportunities as a whole. We tend to be state-based, and who's doing what, and they want to hold on. Everyone wants to own their own little opportunity, and too many egos are involved in that. So we don't have that open collaborative. We love to throw the words around as being collaborative, but we're actually not. And that is it's hindrance to the progression of those companies getting the access to all of the collective help and dollars that there is out there. If startups could go to one place and pitch and get assistance, and we all work together for them, opposed to them having to go and approach every little tiny individual ecosystem. Imagine all the time that would save those founders, and they could focus on what they should be doing, is building their companies, and we worked collectively behind them to support them and push them forward. Like we would all collectively win as Australia, obviously. But we need more runs on the board. We need more stories to tell. We need the media to get behind us. And the only way we do that is with more successful companies. But we can only do that by, we have a lot of amazing resources with our knowledge, our skills, our personal, black book of connections, our dollars. But if we're getting the founders to do the crazy rat race of pitching to everybody individually, it's not the best use of their time. There is a lot of collective support we can do, but we need to get rid of wanting to own every little opportunity and compete state by state. I think that's a big problem here in Australia.
Microphone.
I kind of agree with you, but like, for example, I'm doing a deal that I'm closing at the moment with...
Microphone, please, Andrea.
I'm doing a deal at the moment that I'm closing with a co-investing with 2 VCs and another high net worth, and one of the VCs is in Brisbane, and it's very collaborative.
Good, but if you were to tell the story of how that... So we need to bring more people on that journey of how that works. Sorry. If you were to share that story on how that works, because there's so many that aren't like that. That's all I'm saying is which is awesome. That's actually what we need. We need more of it. So I'm not saying it doesn't happen. We just need more of it for the collective opportunity and the benefit of the company, obviously. So if you have the ability to draw more into the mix or invite more people on, you know, let's just say even if around this table right now, our collective resources, we haven't pooled them yet until tonight.
What size is that round, Andrea? That's probably telling.
It's an oversubscribed round. It's it was 1 and it's 1.2 something.
So an Aussie Series A kind of. Yeah.
Sort of. Yeah.
So.
Yeah, there are also
I think that is right. Having spent a fair bit of time in New Zealand, their angel community are really good at syndicating and cooperating. Our Australian angel community doesn't really do that. They do it by virtue of their size and necessity almost, and have grown up doing that. And most of the angel seed deals you see in New Zealand, there'll be 2, sometimes 3 angel groups investing, and they do that really well, and they share, and they're happy to do that. There's some territorial nature around some of those things and egos, but people mostly get around it. From our perspective, we don't say to anyone one source of capital is the right way to go. Our ideal situation is Allium puts in a quarter of a round, some existing investors or someone strategic puts in some money, and then we can help the company raise the rest of the funds. And we see that mix, particularly for certain sorts of companies, particularly if there's a consumer focus or a desire to get some brand advocacy or support from their networks, or like a neobank, a Zinja, for instance, that can be really powerful and help set up the business to have a broader shareholder base. But we definitely don't syndicate and cooperate in Australia at a seed angel stage as well as we could, and I think that does hold things back. And whether it's egos or if it's just we don't try or there's no real ecosystem that pulls that together, I think that does hold back Aussie startups, and there is time wasted between people pitching at multiple things, going to Innovation Bay, going to Sydney startups, maybe travelling, you know, these sorts of things where, of course, it's natural and it's not pure greed, but, you know, you don't necessarily want to be sharing the opportunities amongst, because you do hard work to do that, so you don't necessarily want everyone else to invest or gain benefit from you or beat you. But there is definitely a need and an opportunity in Australia for there to be more cohesion and more cooperation and people to communicate and work together to help these companies at this seed and Series A stage, because as the market evolves and venture capital gets more dollars and people move up the chain and private companies stay private longer in Australia and capital markets evolve, we will need to have more of an ecosystem funding the beginning of these companies and have more support and education around people investing. We still get some really very silly questions from reasonably experienced investors on our platform asking around, you know, unlisted companies what to expect, what sort of dividends they'll get, you know, what sort of time scales or horizons there are to anticipate, those sorts of things. So we've been hamstrung in some regards by the success of the ASX as an early stage capital market in Australia, because people look to that and expect certain outcomes, or we've forever been pushing companies to list too early in Australia, and that's been to the detriment of long-term success and growth and opportunity. Because if you look at biotech's a great example, as Lynda said, we've got some of the world's best research and development coming out of our universities, but we don't have an established venture capital ecosystem to support and help commercialise that. So it really requires everyone coming together, everyone working together, dropping egos as much as you can, and us creating more of a structure and ecosystem for these seed Series A stage companies to get the capital they need so they can go off and do it. And we need to accept the high risk associated with that, and that you will lose money, but you will generate some returns. And that's what people need to kind of sort of understand in Australia. It's not like the ASX has been, and you need to work out what the reality of this sort of scenario is, and more people to participate and more funds to get, you know, drawn to this sector.
I just disagree slightly. Take a more positive view on the lack of collaboration. Maybe it's a Sydney-Melbourne thing, but and when you're in a smaller ecosystem, perhaps it's harder to have an ego because you basically need the help. So we, Perth Angels, I was involved in a deal a couple of months ago, and the first thing we didn't have enough to complete the round, and we were on the phone to scale to Brisbane, to Melbourne and Sydney, and I know that there's a couple of pitches that are hopefully being organised. The one that's about to go live on your platform, that was backed by Perth, and then Brisbane, and I think maybe Melbourne as well. So syndication does happen.
It's not very common though. It's 1 in 10 deals, sort of.
Yeah.
Doesn't really happen. In New Zealand, seed angel deals are shared 3/4 or more. Yeah. I
think it's going to come down to the deal size, right? And if you're able to fill around within your particular group, there's less of a...
Happen, but yeah.
And certainly in Perth, it rarely happens, and so we're always happy to syndicate, and we invest in deals coming the other way as well. That being said, there is... there's one of the initiatives I have is collecting data from all of the angel groups and then reporting it back to the angel groups. And I'll be honest, that's scale used to participate and then stopped, and Sydney isn't participating. But we've got about 6-7 angel groups who are participating, and that's an example of one where, if we're just sort of a little bit more collaborative, we can actually get better data and then benchmark ourselves and report and so on. So I'll have a chat with you afterwards around some of the things we can do on that. Yeah.
Is anyone in the room from Adelaide? Oh, no one. No. So I will talk about this company that we've invested in. I'll give you an example of... I think part of the problem that we find with businesses is there is the individual or group of individuals that is building a business vis-a-vis the one that's having a go. And we encourage having a go, but it's having a go with no real proper plan. There's a company in Adelaide which is 3 or 4 years old. He's never raised any equity. The company's called Mighty Kingdom. He has been making all the games for Lego, all the games for Shopkins. He got invited a year and a half ago to make the games exclusively for Snapchat, and he's now being invited to build games for Facebook. 53 people, always been profitable. And he'd read about us somewhere, and he said, I'd like to have a meeting with you guys because you have said that you do not take preferred shares necessarily. And I think that is one thing that you mentioned earlier with regards to collaboration. I believe in collaboration as well, but I don't believe in fucking the founders, right? And I think one of the biggest problems with a lot of the collaboration that goes on is groupthink. And they work together to not make it fair for the founder. So anyway, this guy came and he said, I do all these things for these great brands, we're profitable, but I want to make my own games. And we're like, okay, you are skilled enough to do it. So we set up a separate company and we seeded it, and he moved 4 people across, and he won't launch until sometime next year. But we will support that. The guy's got track record. He's okay to give comment. We're happy to take it. And we're not going to sit on top of him and ask for unreasonable terms, because I think everyone wants to mitigate risk, but we're investors. You've got to take the risk. If you don't take the risk, you won't get a return. And I think it's selfish in Australia.
I think on the collaboration piece, I think a lot of the onus might be on the people around this table as well. There's a lot of companies that I have that I'm sure would love to meet with all of you. Plus, I'm sure that there's a lot of companies that you have that I can certainly help out with as well. So I think as much as we say, the education and of the startup itself, really I think it's, at the capital end, the people who are actually funding the startups also need to have, a network where we can actually work out, okay, I've got a biotech that makes whatever it does. It needs to talk to this person as well as I can assist here as well. So it's sort of make sure that the rules are defined within the capital providers, much like you might have someone, okay, they've got an R&D claim, we're undersubscribed, Dave can help with that as well. So I think, the onus really needs to be on the people who are providing the capital as much as the people who are also seeking it.
And the other piece to that is understanding the founders or where they want to go. So what you're talking about, the game developer there, is who are the people? Who is your perfect vetting agent for those founders? So obviously there's always going to be the period of due diligence where you go through the company. That you also need to look at the team. Who's actually going to be growing the company? Are they equipped? Do they have everything they need? Are they in the right, physical and mental state to be able to grow the company? If they take on the capital, what's the next stage look like? Who knows that person? So that's where the collaboration comes in and adds value. So we don't need to always collaborate on deals, but if you want an actual, just a phone call of what does that founder do, what do they like, how do they perform, there are people who know what they perform like every single day, day in, day out, how they treat their team, what the company culture is like. I think it's understanding what it takes to grow a company, and then when they take on investment, the pressure that is on that founder to then grow the company to the next level, and how are they going to perform, who understands what the personality is like. Is it worth putting money into that company? Is the founder worthy? How can we assist them collectively to grow it as well? So who do you rely on collaboratively, whether it be the space operators, where are they operating their business from? Who knows those founders? What does the team look like? That's where another piece of the collaboration comes into it as well, is understanding who the people are. Because you can save a lot of time in the due diligence process if you have really good relationships who understand who's on the team, what the founders are like the game developer, whether he's actually going to develop anything worthy or not, he's worth backing, but you only know that because you took the time to get to know that founder. So those sort of things are added benefits of the collaboration as well.
And that's one of the reasons most investors prefer a soft introduction. Sorry, all I said then is most investors prefer a soft introduction because the calibre of the founder and their integrity is pretty critical. We don't very often invest when we haven't spent a considerable amount of time getting to know the founder, often over a year or more.
Okay.
Everybody?
Yeah. So that's. Is there any issue that you'd like to?
I think I was just more interested actually in the numbers you gave earlier around foreign investment and being so small here per capita versus some of the other countries. And I don't know if we've got time. I was keen to explore sort of the foreign investor side and why that might be, why it seems that other nations are happy to put more money in per capita. What are the numbers you gave?
That was seed.
Yeah.
That was seed investment in this country per capita versus other jurisdictions.
That was quite interesting.
So I think it's a point that we've been talking about in terms of, our market is it's not so much size because it's a per capita measure, but it's more we are immature as an investor community versus those other
just
markets.
goes to show I think that education piece is critical, because that really struck me, the difference between the US, UK, New Zealand and here. I think that was your comment.
Yeah. Well, taking the foreign investment issue, we've seen a lot of foreign investment into Australian companies in recent times. We don't have long historical comparative investment, but just for our March report, we've had a look at the larger deals where the investors were revealed in the stories, and 27% of private investments by number had foreign investors, and 67% by value. And of the 10 largest private investment rounds, 81% of private investment in the quarter by value, half of that's very clearly red, is it? No. So very, a high proportion of foreign investment going into the larger rounds. Does anyone have any thoughts about that being a good thing or a bad thing? Should we be seeing more Australian money going into these larger rounds?
I think in the short term it's a good thing. I love overseas capital being invested into Australia and our economy and our startup ecosystem. We've got, our ecosystem is still maturing, and we don't have a lot of big funds to write a lot of big checks to make these really big rounds that maybe the private round is sort of instead of an IPO or something. Mm-hmm. So I think in the short term it's a good thing, and maybe it will even help in terms of educating co-investors how to run a big round. But hopefully we will get to the point where our big institutional investors in VC funds, at the moment we've got Host Plus and, like the super funds, we've got Host Plus and there's one or two others that have invested in venture. Host Plus is hit the $1 billion mark, which is great, but the others aren't anywhere near that. And there's a whole swathe of them that are just really risk averse and really won't touch it as an asset class. And I think in terms of, I wish we would have more Australian money going into Australian tech investments. I think it would be from those big institutional investors that I'd like to see it start
even
going.
the future funds only put a small amount into
That's
Australian
right.
managers.
And too many of our super funds invest in venture funds, big venture funds, and just big funds generally in the US and overseas, and yet they won't touch it here, and that bugs me.
Yeah, I mean, if you look at, say, Telstra Ventures, so Telstra does some great stuff in Australia, at the seed level, but the venture fund, most of the investments are made outside of Australia.
Just two very quick points. I don't have a problem with foreign money coming in if we can't actually generate that funding ourselves. Of course, I'd love to see more Australian money going in, but I mean, what we want ultimately is these companies to stay here and employ people here and grow here. And actually, if they can't get the money here, and I have seen startup founders do this, they flip up their headquarters to the UK or elsewhere because they're thinking about the next fundraise and their valuation, etc. So I think we want companies to stay here, and if that means actually getting foreign funding, then fine, let's let those funds in. And then I think on the super funds, I completely agree. It's rounding for them, right? And not that you want to be investing people's pensions in risky startups, but given the size they are and the asset allocation, I think and Host Plus is great. I'd love to see more of the industry super funds, also retail and government doing the same.
Host Plus also returns the most to their investors, and they're the ones investing most in startups or venture in Australia. So that's a good thing, I suppose. Now I've lost my point. Sorry, brain blank. Oh yes, no. This is the thing I really wanted to say, and I'm not sure how directly relevant it is, but it is a real touch point for me, and it's something I feel really passionately about. Australia, as you said earlier, Lynda, we've got amazing universities and amazing R&D capacity, and we're developing awesome technology in Australia, and we sadly fall down in terms of commercialising it from Australia. And increasingly we're seeing investors come in and take that technology and just take it overseas and commercialise it and build a business out of it and benefit the economy of the other countries rather than ours. And we know that 90% of all new jobs created in Australia in the last few years were created by companies less than 2 years old, most of which are tech startups. So we need to keep our technology here and commercialise it here. And I feel very passionately about this. I've got kids. And just recently I met someone that's being employed by one of the universities here to help them commercialise technology, except 3 out of 5 days of the funding is going to be incentivised by a Chinese investor to broker deals rather than actually commercialising the technology. And I know it's at their ethics committee at the moment, and their conflicts committee, and I'm hoping like heck they'll deal with it. But that's actually on the table, and that just horrifies me, just to flog our tech.
I think there's a couple of other missing categories from venture capital in Australia. One category is CVC, corporate venture capital. I met recently for the first time a couple of people from Salesforce Ventures that have come out here to set up Salesforce Ventures in Australia. Their plan over the next 5 years is to invest more in Australian startups in Australia than any other current Australian corporate venture capital fund. I mean, that's a great thing for startups, but it's very frustrating. When I look at Australia's broader economy, we have so much capital tied up in some of the most successful banks in the world. Meeting a founder this week who's selling an enterprise solution into one of our big 4 banks. The big 4 bank says, yes, we want to go ahead with commercial pilots as soon as we finish the risk assessment. And the founder says, okay, cool, so what are we talking? It's going to take about 2 years, if we rush it. Seriously, 2 years, before they're ready to do a small-scale commercial pilot. The other thing that I think that we're missing in Australia is public asset building. So we've had about 40 years now of balancing budgets by selling off public assets. We've sold off all these different things that we used to, as taxpayers, own. And now the way the government raises taxes is by taxing us, the taxpayers. They're not doing anything to create any new publicly owned assets. And so when you go to federal ministers and say, you know, why doesn't Australia have a sovereign fund to invest in innovation? They say, oh, well, it's not the business of government to be picking winners. I get that. Don't manage the fund, but raise it, you know, place the funds with professional managers who know what we're doing, you know, and spread it far and wide amongst a range of different fund managers so you get different hypotheses, true diversification for the taxpayer. But start building up some new public assets, and you know, maybe in 100 years we'll need to draw down on that. But in the meantime, it can be increasing what we get to spend on roads and schools and education. And then I think the third and final missing asset is, you know, every year on the first Tuesday in November, all these mug Australian punters go down to the TAB and spend a bit of money on, you know, they've got a 1 in 30 chance. I think there's 30 horses or 20 horses, you know. Your odds, you know, if as a startup investor, about 1 in 20, about the same as the Melbourne Cup if you don't know anything about the horses or anything about startups. You know, I'm not suggesting that everybody go out and spend $50 on a tech startup, but I am suggesting that we need to do much, much, much more to support crowdfunding for equity in Australia. And you know, that's just a free pass to Equitise and virtual. But you know, I really think there's an opportunity there for just regular Australians to participate in the incredible value creation that we have now. You know, we have Atlassian, we have Canva, we have Safety Compass, we have Zoox, we have all these fantastic case studies to show that, you know, everybody can participate in this. It doesn't need to only be high net worth individuals and, you know, resource bosses.
So an observation that I think is depressing for all Australians is the largest superannuation fund that's based out of Melbourne. I don't know how much money they have now, $140 billion or thereabouts. They are happy to outsource, to your point, Andrea, to all these US West Coast, German, Japanese, Chinese funds. And they said that they were interested in having a chat to us, but they didn't do it directly. Right? So they sent an intermediary who came in with a checklist and asked the wrong questions. It's not about, I mean, the question should be investment related, and again, it was about their risk mitigation around us as individuals and how we manage our process, which I get, but it should be more about taking on a manager, supporting them, because we're here to support founders. And I find it really depressing that they're not willing to take risk, other than the 1 or 2 names that you mentioned. Those guys should be doing it on force. There are companies that come out from the US, so Uber was here, Lyft was here, Zoom was here recently, Beyond Meat was here as well, and they went to go see this fund, and they invested in those companies, which I get because they're big companies. But when you have companies that have listed in Australia in the last 12 or 18 months, they don't even take a meeting, right? So Morgan Stanley, Goldman Sachs, Credit Suisse, all these guys try to get them in, no interest. So if anyone has an entree into any of these big, large superannuation funds, ask them to get off their asses.
Mic drop.
Mic drop,
Yeah.
exactly. Have we got one more time? Or?
Yeah. So we said we'd take the regular part of the discussion to 6:50, and we're almost there. Is anyone at the table got any questions of others at the table before we break and then come back for audience questions? Any? Okay.
I just want to know where Raph got his pocket square from, actually.
Okay. Well, maybe you can discuss that during the break. So why don't we all stop for a break and grab a drink and come back
questions.
again in when I tell you to. So, I guess the first thing to do at this point is find someone with a question. Does anybody? Unfortunately, we've lost Rajeev. He had to head off, but we are Tim. Catch. It's a microphone.
Yeah. I guess mine's not really a question. It's sort of an observation linking into the education piece. Sorry, my name's Tim Lee from a company called Fractonium. We're developing a corporate funding platform that's going to turn corporate banking on its head. But basically, as a founder raising money, it's a lot of hard work. And one of the things that I think would be really useful, and I tried to instigate this with some people that are trying to raise funds, is to actually get people together who are founders and actually say, right, come together. If you're raising funding, let's have a disciplined approach whereby every Monday you account to everybody for how far you've gone down the sales pipeline relating to funders. And I was stimulated by, someone who spoke from, not Y Combinator, at the Launch Festival, who actually gamifies the process of going through the sales pipeline in terms of investors, and actually, gives you certain points relating to what stage you're at. And the idea is you hit a target of 20 points a week, and that's your target.
Okay.
I'm just interested if, as to whether other founders might find that useful, where you actually get together once a week and you're in a disciplined approach. And
So
do you think that might work?
Accountability for fundraising progress.
But within a peer group.
Okay. Does anyone have any thoughts on that?
Oh, actually, I just wanted to chime in on this.
Okay, grab the cube.
Yeah. I'm Patrick Hammond. From CRISP, we actually built a deal room platform for capital raising. Wholesale investor. And a part of that is part of the gamification, which is how many points or interactions or touch points have the investors actually engaged with that deal room, and pretty much seeing that progress towards closing that deal. So I think the offline approach would be amazing. Probably something I'd love to be involved in. But I'll pass this back on so I can give it back to the other people.
Peter? We'll come back to you, Andrew.
Yeah, no, just quickly from the founder's perspective, we see a founder-led group of CEOs that get together and monthly, just for a casual catch-up over lunch, where they share their information in terms of who they're approaching, what the response has been like, get advice from each other. They're usually paired, or there's a group of 4 or 5 of them at similar stages, and they self-select into that. It has to be founder-led. It's not something we've tried setting it up for them, but it has to be an opt-in from the founder, where they have similar interests, they're at similar stages of the companies, and they talk about various issues that they have come up at certain times. But for them in that capital raise era of the company, it's really, really valuable for them to get together and share either information or issues that they're having at the time. So we do see that in-person, offline thing work really, really well from founder to founder.
I think the point is capital raising is one of the hardest things entrepreneurs do. Very few people come from a professional or capital raising background. So a lot of the time they might be experts in what they're doing and the businesses they're growing, but have no concept or experience around what capital raising is all about. Some of the terms can be confusing. Even going from a traditional listed markets background to startup world, terms vary and things are a bit different. So one of the biggest things we have to manage helping companies raise capital is the roller coaster of emotions you go through in the process, because you're putting your life on the line, you're putting everything out there and saying, look, I've dedicated the past few years of my life to build this thing I'm passionate about. Now, who will give me some money so I can continue to do it? And in some ways, that's validating what you are or are not doing. So it can be really hard, and it can be a lonely journey, and any sort of collaboration and sharing and helping talk about what you're going through, or any tools or ways of dealing with it, is very beneficial. Sometimes what we do is almost playing the counsellor and having to listen to entrepreneurs who are going through the difficulty of the process and understanding it all, and just sitting there on the phone and listening to them and say, well, it's really hard, blah, blah, blah. It is really hard, and it is the hardest thing you'll do in a startup. And we don't necessarily have this community approach where we do share and talk about it. And that would be a great idea, Tim, but it's very hard. You need something to start it, and you need people to force it together and then let it propagate. You can't say, here's what we do. It's hard for venture groups to say, here's our cohort, everyone get together and chat, because there's also an element of competition and people worried about those sorts of things, and you don't necessarily always want to share some of the things you're going through, because that at some element is a huge risk in your business. And if you say to someone, we're going through this legal challenge at the moment, could completely railroad what we're doing, then, you know, who's to say that that person might not go and tell their common investor or those sorts of things. So
Or the press.
Or the press. And there are reasons that you do need to be somewhat guarded, but there isn't an element of a community-based approach where people do share these sorts of things. I joke that my next startup after Equitise will be a tool that helps manage the psychology and roller coaster of emotions in raising capital for startups, because it's such a difficult part of the process, and it's something that people really struggle with. And you can't necessarily turn to your friends or family or partner and talk about it, and they won't understand it. They might be there and be supportive, but at the end of the day, it's just someone that will listen to you. They won't necessarily give you some, you know, specific input or help. So having mentors is really important as an entrepreneur, people that can have some expertise in that space. Don't just go speak to an angel because they call themselves an angel. Go speak to an angel who's had some experience in raising capital, if that's the problem you're looking at solving, or things, because you get some angels that call themselves an angel that are ex-corporate execs that want to just tell you their opinion and tell you how to go and do something, and that's not necessarily beneficial to you or helps you at that point in your startup's trajectory.
Cool.
So I do think what Tim's talking about is hugely beneficial.
Oh,
It's just,
sure.
It just doesn't really happen, and I don't know how we can get it to happen.
Well,
So Innovation Bay has got a summit club to meet that sort of gap, and that's actually taking off like a rocket because the founders are just loving, and they're finding it really valuable. So because you know there's strict confidentiality rules for the clans because they're put in sort of groups of 8 or 10, and then they meet once a month, and it's not just it's all sorts of issues that founding CEOs have to deal with, and it's working really well.
That's great. How do people in the room get a part of it, Andrea?
They have to sign up on Innovation Bay and look at the Summit Club, and it's not for very early stage, it's Series A on.
okay. Mr. Beveridge.
Yes, do you want me to stand or shall I'll stand?
Oh, however you want to do it.
Well, first of all, I'm Andrew Beveridge, and I've been in Perth for 20 years, but I moved to Sydney about 3 months ago, and I first met Peter probably back in, 2000, when we were less grey.
Something, yeah.
When you were an IP lawyer, very high-powered, and he's even more high-powered now, but he's just greyer. We're both grey, but anyway. So I really like what Peter's doing.
Yep,
but
thanks.
I used to work for UWA, where I was like an entrepreneur. I worked in a sort of IP commercialisation role. I spun out about 7 companies, raised about $30 million. I made a lot of people very rich, apart from me. So, you know, I'm not that smart, really. I've got MUG tattooed in indelible ink on my forehead, but that's okay. So I'm a true entrepreneur. I'm not an entrepreneur, because if I was an entrepreneur, I'd be rich by now, and I'm really not. But I like the space that I play in. And I recently joined CSIRO, Data61, where we've got 1,100 very smart researchers, and we're doing some great stuff. We've spent $600 million of your money, taxpayers' dollars, over the past 3 years, and there's some great things coming down the track. And I manage research projects, but I also work with our business development and commercialisation team to get that out of the lab and into the community. First point, if you imagine like a triangle with 1% at the top, 19% next tier, and 80% at the bottom, that's the kind of the market that we're playing in terms of the early stage investment market. And the top 1% are the unicorns that we are all looking for, but really we shouldn't even bother with those because there aren't that many of them. The 19% is what I call the sweet spot. And do you know what? Nobody in this room is looking at those. Nobody at all, because people are all expecting factor of 10, return, unicorns, da-da-da-da. But the 19%, there might be a factor of 2 or 3 or 5. 19%, there's a big number of them, and they're the ones that never get funded. And the bottom 80% are the ones that should be either killed off at birth, the kind of the crazy ones, or they should be massaged into the kind of the 19% area by kind of mentoring, helping over a year or two. Yeah.
Second point. Do you have a question?
Yeah, the second point I want to make is a really important one. I have been in UniSuper for 20 years, and it's generated 8% a year reliably for 20 years, and it's great. But do you know what? I would be very happy if it generated 7.9% a year, and that 0.1% went into an easily accessible early stage fund, 50k to 500k, because that's the really hard part to get. And then if you can follow that on with kind of the 500k to 5 mil, that would be that would transform the sector in Australia. What's happening in South Korea is fantastic. The government there is launching an 8% fund. They want to invest into Australian companies, and I'm talking to them. So come and talk to me later. Thank you.
I'll take that couple
I think it's interesting to hear that, and from the the startup's point of view, that's good, but the flip side of it is the investor's side. And, you know, the earlier stage you invest, the higher the risk. And, you know, statistically, you have to invest in a minimum of about 22 companies over 2 years. And every single one of them you have to judge as having the potential to produce the returns for the entire portfolio. And the reason for that is because 1 or 2, possibly 3 of them are going to produce the returns for the whole portfolio. You're going to lose your money on a whole lot of the others. So it's pretty tough. Like, you can't invest in something that's going to be a good lifestyle business or that's going to produce moderate returns because the economics of investing are just not there.
I agree with that, but I think the model is wrong. The model's broken.
Because you can tell us how to make money otherwise.
Kevin.
Talk to Rob Newman. Is who here, apart from Peter and I, knows Rob Newman? Rob Newman founded Nearmap. Rob's now worth $800 million. He came up from the US 20 years ago with about $10 million that he made out of a QPSX. And then he started his early stage fund that Peter and I were quite well informed about, and he's parlayed that into $800 million. He's a serial entrepreneur. He's a really nice guy. He's a smart guy, and he knows how to do it. So we should have people like Rob in the room in Sydney. So you guys are doing exactly that. So the fact that you can sort of mentor and help these kind of early stage companies is fantastic. So well done to you.
Cool. Kevin.
Hi, Kevin from 8 Mobile. I don't think I'll go grey, just to look on the bright side of things, but there is a downside. The short version is role of government. I think it's Lynda who said maybe levelling the playing field with imputation, negative gearing. Any strong views are out, apart from kind of getting out the way and making it more attractive for investors to look at other asset classes? Anything else they should be doing, or should they just get out of the way?
Who wants?
So the early stage innovation company tax relief that they put in place has kind of failed, I think. ESIC, yeah, it doesn't provide the right incentive. It should be a little bit more like in the UK where they got EIS, SEIS, and it's a bit more blanket. The hoops you have to jump through. Ourselves, when we help companies raise capital, we almost never actually market or highlight that as a part of it because there is liability both to the companies and us, because you don't know if the ATO is going to come back and say, well, actually, we've deemed you not to be ESIC, so you've got to give back those tax credits. So the tax benefits of investing in startups in Australia needs to be reviewed, but we need to have a push at a federal fiscal level where it is this investment, whether it be a co-investment fund in Australia that basically has a panel and they will invest in anything that any VC that can get to the line and pass their hurdles, the government will just match co-investment, or they more aggressively go after some of these opportunities and force some of the capital. The current government co-investment stuff in biotech's not bad, but thereafter some of the clean energy stuff, that's really it. But the government needs to take more of an aggressive approach to help support growing innovation in Australia, and that just doesn't exist.
There used to be the IIF license program. Actually, is my microphone working? Yes, it is working. So the IIF program that finished about 10 years ago now, which was government sort of co-matching in the VC fund itself, within certain requirements. But that was I think, quite a successful program.
I think we had a government, the Turnbull government tried to put innovation on the agenda, and I think it failed the sector miserably. And I think all it did, sadly, was, this is just my thoughts, obviously, it frightened the general population into thinking, oh my God, technology destroys jobs. And I think there's quite a broad anti-tech and anti-startup kind of sentiment. And it failed to educate the population about the reality that, in fact, it's actually technology and tech startups that create jobs and are actually really important for our economic future. And because of that, that's fed into the government, which now thinks that, well, we don't have the electorate support to get behind tech and innovation and startups in Australia. And the sad thing, the really scary thing actually about it is that countries like New Zealand, Israel, Tel Aviv, Israel, Singapore, huge, the UK, the governments there are investing huge amounts of money and into developing structures that actually support startups and the whole ecosystem. And I think our government is really failing us there. It's really a real problem.
I think that's right. The National Innovation, it's a National Innovation Science Agenda has announced all this fanfare, and there's very little follow-up to some of those measures that they announced to encourage that. Then coupled with negative press about the R&D tax incentive, I've heard negative reports about ESIC incentives. Like you said, the companies potentially under review, the investors potentially putting themselves under review. I think they've actually failed quite miserably, and Scott Morrison's government are not particularly pro any of that at the moment.
So it's not that they're not pro it, it's that it failed with the electorate. They tried to go out with this innovation agenda, and to anyone that doesn't work in startup like us, that sounds scary. And they maybe need to make some unpopular policy decisions and just go ahead and do it and not try and communicate to people in small rural centres why we're investing in innovation, and just say, well, we've got the Future Fund and that's got a whole lot of money that we're responsibly managing for the future of Australia. Instead of investing that offshore, we're going to allocate a whole lot of that towards just investing in Australia and growing companies. And maybe it is more like this $2 billion SME fund, and it is just dedicated towards investing in startups. And politics is terrible in two-party preferred systems around the world, and nothing's working anywhere. So maybe they just need to go ahead and, stump up, put a whole lot of money into it, and just...
I don't think they have the will, unfortunately. We've got the wrong people. We voted the wrong people in. We did. We were mugs.
Was the alternate that much better, though?
I suppose at the time I thought, Jesus, they can't be any worse.
Well, yeah. Question from the red
Can
box.
I'm just going to very quickly
sorry.
comment on that.
Okay.
Yep. So a couple of things. Agree with Jonny on the tax incentives. They're not as good as other markets. The government doesn't pump as much money into the sector like Singapore and Israel. I mean, I know even just for fintech, Singapore, the government put together a $225 million fund for 5 years. I mean, where do we ever see that kind of money? But I also don't think the government should fund. I think the government should incentivise industry and the investor community to fund. Having said that, there are lots of great grant schemes, but actually I think they should be loans, and Israel does this really well. They lend money, and to the extent that the company, sure, it's a risk if the company doesn't succeed, but to the extent the company's successful, they should pay back that money over time, and it gets refunneled back in. And I also think there probably needs to be some sitting back and going, well, actually, you can't back everything. Some sort of thesis-driven investing, some contrarian investing. So where does Australia actually have a competitive advantage, right? Is it biotech? Is it renewables? Is it, whatever it is? But rather than sort of trying to have these blanket schemes, let's actually invest and be forward-looking and really back those areas. So I think, very hamstrung, very sort of not forward-looking, very against sort of taking a risk and having the appetite to invest. And, I agree with you, and I was saying to someone in the break, there's too much focus on pulling minerals out of the ground and sticking on a ship to China, rather than actually, we've got to change that export profile and actually invest in intellectual capital, because we're not generating enough, and to the extent we generate it, we don't retain it, and we're very protectionist with visas about attracting it. And if you want it built here, you've got to lend people in to build it here. Anyway,
I agree with you. Absolutely, I applaud what you say. Just one thing that I wasn't actually only talking about the government investing capital, I mean investing in the ecosystem. So for example, I lay in wait for Scott Morrison the election before last, and I collared him. And the reason I collared him is because there is no sensible legal vehicle to syndicate an investment into a startup. They're all really expensive, they're cumbersome, and they're expensive, like unit trusts. You've got to lodge a tax return every year, even if it's a passive investment, all that sort of stuff. And we don't have any sensible vehicle to encourage the cooperative investment that we've been talking about. And I just think it's just a legislative change that, you know, needs a little bit of investment into creating some sort of sensible vehicle to house angel investments and syndicated investments in startups.
We have a question from the red box.
Sorry. My name is Kopi. I'm a founder of Healthcare. It's an online network for doctors and nurses, like LinkedIn for the healthcare professional. But lot being talked about angel investment and VCs, but I want to get your thoughts on corporate investment. How the corporate investment in Australia, because I raised $1 million last year from a listed company. It's been great, but obviously I've been growing the business, and now I want to raise the following round. I'm not sure whether I should go down the corporate path again, or should I reach out to VCs to grow my business outside Australia. So just want to get your thoughts on corporate investment in Australia, basically.
It's a pity we don't have Todd Forrest, who was going to be here from NAB Ventures. Anyone want to take that one?
Basically, would VCs look at a business like us who got corporate investment for the following rounds, basically?
Would depend on the terms of that corporate investment. If that corporate investment was tying you up so you can't actually sell to other markets, then I think it would be very, very difficult.
It's a clean investment.
I think personally you need to look at how much value the options, you know, the investor options can add. You know, is another corporate investor going to be able to add more than just more money? And are they going to provide channels for you to sell, or you know, all those sorts of things that will help you commercialise and scale your business rapidly. And it might also be that particular VCs or other investors might have particular expertise that can help you, but that's the sort of thing that I'd be looking at. I'd just be researching what they can do for you and then find someone you trust. That's what I'd do.
The corporate investment piece is interesting, and it is about the channel partners. So we've seen a lot of companies, especially here in Sydney, in the medtech space, who have ended up doing a joint venture to develop a new product that is aligned with the interests of the corporate as well. So it depends what they can bring to the investment. In addition to the dollars, is it contacts? Is it a clear channel partner? Are they going to open the doors for you, or do you actually want to create a joint venture with them? So I think it's rare to see corporates just put money on the table unless they have a vested interest in whatever it is that you're working on. And what relationships do you have existing in that sector that you could leverage to enable them to release some of the dollars? So I haven't seen much corporate investment just being released into any sector unless it is aligned with their own, if they want to innovate themselves internally, or if they want to shift the dial, or if they're actually looking to deploy capital into a sector where they know that they're probably not going to have relevance much longer, and they need to invest in future tech.
You can also access the commercialization part as well.
Okay, Andrew?
Yeah, just really comment on the role of governments. And again, the role of governments around the world is they're not really very good at doing this. But what I was going to say is that back in the late 90s in Europe, the European Commission realised that there's a really market failure in the whole innovation space. And what they did was said, look, what we'll do is we'll fund the 100% of the incremental marginal cost of doing a small project with the university. So SMEs partner with the university, they could get a £25,000 grant plus $10,000 grant towards training the company in a new area of tech. So relatively small amounts of money, but that allowed SME to work with the university, take on new technology and transform the sector. And we need something like here, because dollar for dollar funding is really holding the country back big time. Because where do you get your dollar from? You know, if you can get a dollar grant, it's great, but if you can't raise the dollar to partner with the dollar from the government, you might as well not bother.
Sure.
Yeah.
You had a question, I believe.
Yeah, cool. Hey guys, my name's Ed. I'm the founder of a company called Gigged In. We're a tech startup, work in live entertainment, work with music festivals, concerts, comedy, cinema, stuff like that. Raised a couple $1 million so far. I've just got a bit of a general question around just the thesis and thinking behind how you guys look at investing at early stage in general. So from my experience, and maybe I haven't spoken to enough investors in Australia, I've noticed that a lot of early stage investors will typically apply a portfolio approach towards investing at the early stage. So, you take a lot of small bets in a lot of companies, and then, 1 out of 10 might return 10x, 20x, whatever the case may be. But then Peter Thiel likes to also talk about a different lens of investing, a contrarian one, and one where you have really high conviction and you actually concentrate your investments. You might have a vision for the future, believe technology is moving in a certain way, and then have a really clear thesis behind that, and then concentrate really heavily. Me personally, like if I haven't had the luxury of having a shit ton of capital to deploy myself, one day I will, hopefully, but I'd be swinging more for the fences personally in terms of, so for example, like Reid Hoffman would invest in a Friendster, and that would go to zero, and then he'd chuck money into Facebook, and then that would become very successful, and I would have I've got a lot of respect for the fact that there's a thesis behind, okay, a social network's going to come together, and then I'm going to invest in that, and I'm going to have a lot of conviction behind that. Would you guys typically agree with the fact that portfolio investing is like the best way to invest in early stage? Or does anybody agree with the fact that and I think it might have been like Warren Buffett or Charlie Munger that said diversification is protection against not knowing what the fuck you're doing. Actually, without the F word, they're a lot more articulate than I am. But yeah, I'm really just keen to hear a point of view on from all of you guys, I suppose, we're time permitting, around portfolio investing versus having high conviction at this early stage. Especially, one last, and I'm sorry, I'm just ranting a little bit now, but typically as well with regards to technology anyway, and technology companies, the ones that have embedded network effects as well will become natural monopolies. So the returns become extremely concentrated amongst a select few types of companies. So should it not really be early stage, should early stage investing in a quote unquote sophisticated way, which is very debatable by the way, and I'm just riffing off the top of my head, should it not really be about having, finding really amazing killer team with the style of business that's conducive towards things like network effects and being able to create durable competitive advantages, and then concentrate really hard on that, and then seed a company with $1 million and put a large part of the portfolio within a specific few businesses to support them to the end, as opposed to taking small little bets in companies and then maybe not even following on in some circumstances.
So statistically, there are two ways to invest at that very, at the seed stage that can work. And by work, I mean the investors actually make some money, because it's not a philanthropic exercise.
Of course not, yeah.
One is the portfolio approach that I talked about earlier, and that's more for relatively passive investors. But there are a lot of angel investors, not a lot in Australia, but there are certainly some, and there are a lot in the US and other places around the world. And they're kind of successful entrepreneurs that have had a lot of experience and have a lot of experience in growing a particular type of company, and they invest in 5 or 6 companies, and they invest relatively large checks, but more importantly, they invest a day a week of their effort and expertise in working with those companies to help accelerate their growth and maximise the returns on their investment. And they can do really, really well, but it's just a different strategy of investing. I don't think there's, all sizes, the same strategy doesn't fit everybody, I think.
I think diversification is hugely important, particularly at the early stage, and that's what we advocate for. We can't give proper financial advice on Equitise, but we point to the statistics and the probability of generating an internal rate of return of 25% or more, which is what the VC sort of hurdle rate is, increases exponentially when you go past 20, 30, 40, and by the time you get to 90 startups in a portfolio, probability of you generating that return is 99.99, whatever. So there's so many variables in investing in early stage companies that are outside of your control. That means diversification is very important. You can concentrate your focus and your bet on sectors or those sorts of things, but you're still going to diversify at some level across who you're backing or what size or stage or those sorts of things. If you have the time, the capital and the access to deal flow, then sure, you can try and pick winners and go big, and that's how you generate the huge outsized returns. And Jason Calacanis example is sort of, he parlayed some money into Uber, and also he's now invested in Robinhood and a couple other things like that. And he did have an opportunity at the right time to make a few sort of larger bets, but he's also diversified as well to get that broad exposure. The way of thinking about it is, and this is how a lot of smart early stage investors look at this, and this is where some of these bigger funds might invest, is it's a very cheap option to get on the cap table and get preemptive rights early.
Yeah, sure.
And you might put in 100 or a couple $100,000, and then at the next round, if everything's going well, then you go, great, we'll take as much as we can. And if it's still doing well, great, we'll take even more. And so that's a smart strategy. But for almost everyone in this room, the way to play startups and invest is to have a level of diversification. How wide that goes is potentially determined by how much capital you have, how much time you have, and how passive you can be. But what we do and what we advocate for is, you know, sure, try and pick a couple companies you want to really invest a bit more money into. But if you've got $20,000 to invest every year in startups, put $1,000 into 20 companies.
Sure.
That's the best way to do it. And probabilistically speaking, that's how you'll generate the greater returns.
Okay. We've got a limited time for more questions, so can we...
Yeah. Okay. I'm going to talk about something which is actually not as successful as the other two people who just spoke. I haven't raised any money. But I was not trying to raise a little money. I was trying to raise $30 million. And my ambition was a bit big too. You must have heard of the Tesla big battery in South Australia. So I wanted to build something like that, but not in batteries. It's called solid pumped hydro. So it's a new technology. And I didn't get the money so far. So I'm thinking, maybe I tried to do something too big. Should I have tried to do say a smaller version of it, which might fit, let's say, a large farm or a factory, and which would cost maybe $2 million? Would that have been the better way to go about it?
I think I might have met you at StartMate,
Yes.
and heard a little bit about what you were doing. And yes, I looked at that and thought, that needs a huge amount of capital to succeed. It's a no-brainer as a no for me. And I'm pretty confident that a lot of people would think that as well. And it wasn't that there was, you know, I remember thinking that what you were doing was actually quite exciting. But people don't write big checks unless there's either the founder has a really impressive track record at building a company and getting a great exit, and so they know how to build a company and commercialise the technology. Or there's some evidence of that it's going to work and make money, and you know that it's actually, you know, that there's sort of product market fit, that it's actually going to succeed. And at the stage that you were trying to raise, it was a huge amount of money that you wanted to raise, and I think personally that it would have been I would have been very surprised if you'd managed. And it wasn't because I mean I'd really thought what you're doing was awesome, but it was just like it's almost in theory we need all this money just to build an MVP, and I don't know, SoftBank might be able to write a check that big, but not many others would.
There is no real alternative. That's at present, the only option are Tesla batteries, and which most of us don't realize they have to be repaid.
Sure. Yep. Okay,
Try Grok Ventures.
Question at the back.
Hi, Deborah Taylor from Open Sparks. I'm a founder over 25 years. I've done a dozen startups, most of them my own funded businesses. The last 2 years last two startups I've been having funding from seeds and other investors. So I've now done 2 seed rounds. My last round was oversubscribed by 50%, which shows me that I probably undervalued the val at that stage. And so I want to talk about the valuation. How do you value a company, especially when we're going into a Series A next year? How do you value a company? Because, you know, you hear about it's got to be X times multiple of revenue, but then I hear of other startups who have Series A with no revenue, and they're doing like 10 mil Series A on a 60 mil val. It just doesn't make sense to me. So I'd like to bring that conversation to the table. How do you value businesses like startups, scale-ups, Series A, etc.?
How long have we got? I don't think we have enough time to answer that fully, but...
So I won't answer it, but just a comment. I don't think that the fact that your round was oversubscribed is an indication that it was undervalued.
Okay, good.
I think that can be a good thing.
Yep.
The alternative is, it being undersubscribed and it distracting you from running your business for 12 months. The other thing is that the valuation isn't just relevant for that round, but for subsequent rounds as well. So it needs to, you need to think of it in the context of when am I next raising money, and what will the uptick in valuation be from this round to that one?
Okay, so what's the what is that uptake? So what do you expect? What's the rule of thumb about the uptake from one to another?
Depends on the type of revenue. So, all a lot of us tech investors, we just want SaaS revenue, recurring revenue, and the starting point is usually 10 times the last year's revenue. But I would say I couldn't agree with you more. I think you've had a massively successful round. It was oversubscribed, and I couldn't agree more that it's not necessarily an indication that it was undervalued. And the fact, and even if it was undervalued a little bit, that will play into your favour for the next round, because in the next round you have to demonstrate progress from the date and the valuation that you raised at to the next round, and at that particular point in time you're going to have to justify the growth from that val to that val, and if it was lower, it's actually makes it a bit easier for you for the next round. So I think that's probably going to work in your favour, because I often do my sort of valuation coffin speech. It can kill companies, and I've seen it happen. You have these really charismatic founders that manage to raise from often angel investors or high net worths, people that aren't used to investing in startups, and they raise at a big overvaluation, and they absolutely cannot get their Series A in. When it comes to Series A valuation, you'll probably be going to professional investors like venture capital funds, and it works a bit differently. They'll give you what they're prepared to, the valuation at what they're prepared to invest at, and it's up to you to sort of take it or leave it generally.
Is it a SaaS? Is it a software startup? Is it PaaS? Yeah, cool. So then, as a rough rule of thumb, if you're raising roughly about every 2 years, I think existing investors would be pleased, and incoming investors would be interested if it looks like the business is about doubling in that 2-year period. And so valuation should reflect that.
Well, okay.
Well, I think
this is the
But the biggest thing to point to is what's relative or comparable to what you're doing. That's what a lot of startups don't think about. Is they don't look at who's doing something similar at a similar stage, and they think, oh, well, this company raised at a revenue multiple. That might not be appropriate for what you're doing. So you need to kind of look at some comps, and it's great that Techboard and other things like that are now providing data so that you can do that. But never become fixated on what someone else has done unless they're directly comparable to what you're doing, because it's not a point of comparison. And if you go in and say something like that to an investor, oh, but so-and-so raised on this valuation, they'll think you're an idiot, to be frank. You need to understand your market and the size and stage of what you're doing in the sector you're in to be able to have a reasonable conversation and articulate why you think you're worth what you're worth, and how you've arrived at that, and it just becomes an honest and frank conversation with the investors. And if it's like anything, no investor's ever really going to tell you that your company's undervalued and that it's cheap.
Well, I want you to double the business in 2 years. Tell me how much money you need to execute on a plan that achieves that, and then we'll talk.
Yeah, and just, sorry, very, very quickly, I totally agree with Jonny. There is art and there is science, but you've got to build in as much science as you can, and it is about product and it is about market. So, as Jonny said, what is the market you're going after, and how do you size that, and, what is your product, and how is it different to other competitors out there, and how do you then sort of break that down and go, well, how can I sell this? How do I go to market? What can I achieve? What's the opportunity? So you've got to build in assumptions around all of these things to the extent that you can. But it is a complicated exercise.
So comment from Dave. Then I think we go to the last question.
I think all my points pretty much go. I was going to say that, you know, valuation is something you know talk about for hours. But the one thing I learned from personal experience is that there's no real rules, and ultimately you have to be happy with it. And like you're saying, there has to be science behind it. I think, you know, I have a science background as well, and I'm always looking for the hard and fast rule and everything, and you times this by this and you get this. But ultimately, you know, you need to be happy, and sure, looking for market comparisons is certainly a clear way, but there isn't any real rules, and I think it's also could be to the detriment that everyone tries to make a model that says that a startup has to be valued like this, because every startup needs to be different, or else they're probably not going to go well.
Okay, blue box.
The last question, no pressure. Hi guys, my name's Betty. I'm the founder of Hustle and Heart, and we are basically matching women with the coaches that they need on a data-driven platform. Now, as a female founder, I'm super aware, that is all kinds of echoey, I'm super aware that only 2% of global VC funds go to women. And I just wondered if you guys had data about the Australian market, or maybe how many women are applying for investment with you guys versus how many you invest in. That's a big question.
Can I just jump in? We did a post on International Women's Day looking at investment rounds of over 5 million, and the percentage of the companies that were female founded, or had a female founder,
right,
was about 26%. Right. That includes Judo, and their previous round, not the one they've just announced. But you know, Airwallex, Canva, Expert 360, there's a lot of very successful startups in Australia that have raised big rounds that have a female founder. So that the data that the international data doesn't apply here, and I wish people would stop quoting that 2% figure, because it just isn't true in Australia.
Right, that's why I asked the question, just to see if this market was different and how it compared to other markets for female founders.
But you are quoting above 5 million.
Yeah. We don't know whether there's female founders in all those other companies. We'd love to do that work, but we're too busy doing other stuff. If somebody wants to fund us to do that, we'd be very happy to talk to you.
Yeah, like that's important work.
Sure.
What does, sorry? The Wade Institute, cool. Great.
Just quickly, at an angel group level, in Perth Angels, we've got, I think, 35 members, and I think it's 1 female. And so at that early stage, I think on some level, that's working against female founders.
Right.
I'd like to think that investors are smart enough to not be assessing an opportunity based on gender, but I think there can be some indirect secondary signals. It's all part of the mix. And so, it's a problem of female investors as much as female founders.
I think we also need to tell the story of how successful female-founded businesses can be. I was chatting with one of Perth's VCs, who unfortunately is stepping out of the VC role for a period. Most of his more successful companies that he's invested in have all been female-founded. And I think there's other reports that have come out about how the rate of success of female-founded businesses might actually be higher.
The returns on female-founded businesses are statistically higher. There's lots of data.
Yeah.
Cool.
I guess that doesn't address the...
And that's a nice positive way to... Yeah, okay. So to allow a little bit more time for chatting at the end, I'd like to thank everyone for coming along, and I'd like to thank the great people that have around the table that have given up their evenings to come and have a chat. Really enjoyed it. And this whole session's been recorded, so this will be available on StartCon's website, YouTube channel within the week or so. Awesome. Thank you so much, and a massive thanks to StartCon for providing this venue. Awesome things, and thank you to RSM, and thank you to Radium, and awesome. Oh, and report your deals. It really helps.